Just joining us, this is Taking Stock on Bloomberg. I'm Pim Fox. Now, First Solar has the technology that promises to be more efficient, but does that really matter? Let's bring in an expert in the world of solar technology, Ishita Manjrekar, analyst with Primary Global Research. She joins us from San Francisco. Ishita, welcome to the program.
Thanks, Pim. Thank you for having me.
Ishita, before we get to the details of First Solar and some of the other solar companies, just outline for those of us who are not experts in the solar field that there are basically two different kinds of technology when it comes to converting solar energy into electricity, correct? Outline those for us.
Right. So there's two types of technologies that convert solar energy to electric energy. The first one is based on silicon. So the type of technology is typically called crystalline silicon-based technology, where the raw material used is silicon, and efficiencies that modules typically demonstrate using this technology are between 15 to 22%. So they're the higher efficiency module or the higher efficiency technology. And then the second type of technology is called thin film technology, which is basically a very, very thin layer of semiconductor material that's typically coated on glass. That's what First Solar does. And the efficiencies for this type of technology are comparatively lower, so between 10.5 to typically 11%. That's where First Solar is at this point. Now, consequently, because of the lower efficiencies, prices are also lower, traditionally have been lower for First Solar technology, and that primarily comes from the fact that they're not dependent on silicon, and so are not dependent on demand and supply dynamics that the silicon industry goes through. And so First Solar has always been more competitive than silicon-based technologies. However, now that dynamic is changing since we've been through, or we are in the throes of a fairly intense silicon oversupply situation. And what that's done is it's brought silicon raw material prices crashing down, and consequently silicon-based solar module prices have come crashing down. And it now turns out that they're more competitive than a First Solar-based thin film module. So that's how the industry has really changed over the past 6 or 7 months.
All right, so you've got this crashing price for polysilicon, so that's upset the pricing structure. What about on the finance side? Is there still financing available for a lot of these solar projects? Because in the past, you and I have talked about how it's really up to a lot of government funding, whether it's in the United States, China, or indeed in Europe. What's the government funding picture like?
So there's two aspects to this. There's the one aspect is government funding, where governments institute programs to support the development of solar energy. Solar energy obviously isn't competitive with conventional coal or natural gas-based generation technologies. So governments are incentivizing producers by paying them what's typically called a feed-in tariff. And so that's one side of the story. So there's many markets that have existing feed-in tariff structures, especially in Europe. There's Germany, there's Spain, there's Italy. And that's all going okay. But the other side of the picture, as you mentioned, was financing. So all of these solar projects, especially the large ones, anything in excess of 1 megawatt, is very intricately tied with the credit markets. So typically, a 1 megawatt solar power plant will require between 6 to 8 million euros in debt financing. And banks are finding it very difficult to come up with this kind of money at this point in time. So that's definitely the biggest problem that the solar space is facing right now.
All right, Ishita, just stay with us. We're going to continue the conversation. We've got more on solar technology. Can the Chinese domestic stimulus plan actually revive the market? And what's the outlook for the stocks? We'll tell you. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. Okay, let's continue our exploration of solar stocks in the solar industry with our expert, Ishita Manjrekar, analyst with Primary Global Research, joining us from San Francisco. Ishita, okay, you talked a little bit about what's going on in the European markets and government financing. What about the domestic stimulus package that's in China? Is that going to keep the market alive in China?
The stimulus package in China is actually a fairly positive step. What the problem there is that it's more long-term than short-term. I mean, as far as the effect that it's going to have over the next 2 quarters and the performance of these companies over the next 2 quarters, that's fairly limited, and that's my concern with the Chinese stimulus plan. But as far as the basics and the fundamentals of the plan are concerned, they're definitely a step in the right direction, which I think will affect these companies positively more in the long term than in the next couple of quarters.
All right, then let's talk about 2 companies in this whole issue of accounting and how they account for various kinds of sales. Because indeed, I was speaking with Gordon Johnson of Hapoalim Securities. He covers the industry group for Hapoalim, and he was talking about how some sales from various companies, whether it's Suntech or First Solar, those sales of their solar products are actually going to entities that have real relationships with those parent companies. Let's start off talking about Suntech. What's going on there?
As far as Suntech and First Solar are concerned, here's what's going on. Both of these companies are talking about Q3 and Q4 result being good quarters for them, and that's primarily because the German feed-in tariff typically takes a step down, so it reduces by 10% at the end of every year. What that does is that seasonally there's this push to install as much as you can before the end of the calendar year, just so that you can take advantage of the higher feed-in tariff, as opposed to if you delayed it and installed it in the next calendar year. So traditionally, Q3 and Q4 have always been good for almost every solar company that operates in Germany. Now, what's going on in this current economic condition is that there isn't any financing available. So even though there's the intent, bankers aren't willing to finance these projects. So what companies are now doing is they're working with their integrator partners and their customers and their distributors to build these projects anyway, without financing. So essentially the projects are being built, panels are being installed without financing, and they don't have an end buyer. So they're unsold projects. As a vendor, a Suntech or a First Solar can then give their customers extended credit terms of between 7 to 8 months, so the customer doesn't need to pay them immediately. And the hope is that once these projects are finished, completed, connected to the grid, and a source of income for a potential owner, they'll sell it whenever it's complete, and hopefully everything will work itself out. It's an ambitious plan, but it's a risky plan.
Now, when you talk about the risks to the plan, are there any concerns as to the accounting for all of this? Because it seems as though if, for example, Suntech making sales to companies that are controlled by the management of Suntech, is that too close a bond for your taste?
Once again, it's all about how these companies can manage this type of accounting. There's definitely, in the case of Suntech, the organization that you're talking about is the Global Solar Fund, which is in fact controlled by Suntech board members. And it's all about how well you can manage all of this, right? I mean, at the end of the day, if these projects remain unsold, that's when it becomes risky, or that's when the risk becomes real. But if these projects do manage to find buyers at the end of the day, then everything works out for these companies. So it's basically a gamble that they're trying to take, and taking advantage of these higher feed-in tariffs in Germany before the end of the calendar year.
Ishita, let's just turn back to China for just a second. Are the Chinese companies better positioned right now because they have a relationship with the Chinese government or with a local Chinese authorities that is going to keep the production lines open, whether the prices continue to crash or not?
I wouldn't say that. I think the Chinese companies are in a better position than their European or American peers, only as far as the Chinese market is concerned, but I don't expect for the Chinese market to really take off in 2009. In 2010, when that happens, towards the middle of 2010 when that happens, the Chinese companies are definitely better placed. As far as keeping their production lines running because of support from their government, that's not a sustainable model, especially given that all of their current markets, there's no real demand there because of no financing. And it's all coming down to that. Unless the Chinese market is able to provide the Chinese companies with a legitimate marketplace to sell their modules, it doesn't really matter, in my opinion.
All right. I want to thank you very much, Ishita Manjrekar, coming in from Primary Global Research, giving us some detailed information about the solar industry.